Good evening. It's 6 o'clock, and I'm calling this meeting to order of the Financial and Audit Committee. Could members present, Julio Martinez? Members present, I was going to ask for that.
I can do roll call.
I got the
for you
time,
if
I
you'd
didn't
like.
get the date, October 27th.
Okay,
I got 6 o'clock.
thank you. And I'll do roll call.
I'm sorry, yeah, we'll do roll call. Roll call, please.
Councilmember Martinez?
Here.
Councilmember Fenn?
Here.
Treasurer Patel? Chair Vanderpool stated he would be absent this evening and asked for an excused absence. Vice Chair Rader?
Here.
Resident Member Christian Fernandez also asked for an excused absence this evening.
Was she here last time?
He,
I'm sorry.
I don't remember if he was at the
I
last
get my
meeting.
committees mixed up.
Yeah, I remember him
Was he?
being here last time.
Okay.
Okay.
I will remember him next time for sure. Okay. Is there any requests for excused absence? Chairman Vanderpool, excused absence?
Yes, Fernandez and Vanderpool,
Okay.
yes. And just to clarify, we do have a quorum with city manager and with finance director here.
Very good. Thank you for attending. Adjustments to agenda. Does anybody have any adjustments to the agenda?
I'm good.
Okay. Having said that, any conflict of interest disclosures? Seeing none, we will stand for the Pledge of Allegiance, please. And there we are. I pledge allegiance to the flag of the United States of America and to the republic for which it stands, one nation, under God, indivisible, with liberty and justice for all. Thank you. Nicole, is there anybody here for public comment?
I have no written requests for anything not on the agenda. Lisa, do we have any callers on the line?
There's no callers on the line.
Okay, thank you. Approval of minutes. Could I have a motion to approve the minutes?
So moved.
Second, please.
I'll second.
First and a second to approve the minutes.
Do we have any
Roll
public
call.
Any public comments on it?
Is there public comments on that? Just a second.
I'm asking you to ask.
I understand. I just wanted, in case I do this again, get this right. Okay, is there any public comments?
I have no written requests. Lisa, do we have any callers on the line?
No callers on the line.
Okay. Okay, now we'll roll call, please.
And actually, for this committee, we can do all in favor, say aye.
I'm sorry, say it again.
For this committee, we can do all in favor, say aye.
I see, instead of a roll call. All in favor, say aye.
Aye.
Opposed? Motion carries.
Thank you.
Okay, guess the first business is C2, first quarter cash and investment report. I guess, Jennifer, you're up.
Yes, thank you. Good evening, committee members. We have for you today the first quarter cash and investment report for fiscal year 25-26. This report will take you through the end of the first quarter, which is September 30th of 2025. In the report, you do have your bank balances by month for July, August, and September, as well as the significant transactions that took place during the quarter. Your total investment earnings for the quarter is north of $2.2 million. And there was a BMO CD that matured on July 30th of 2025. And that was reinvested into a 6-month CD at an annual percentage yield of 3.68%. With that, you do have some reports within your attachments and investment certifications saying that all investments were in compliance with the city's investment policy. And with that, I'm available for any questions that you have.
Is there any questions for Jennifer on this topic? If not, I'm looking for a motion to receive and file.
So moved.
First and second to file.
Before we do a motion, I'm going to just check and make sure we don't have any public comments.
Say that again, please.
Before we do a motion, I'm just going to make sure we don't have any public comments.
I see. Is there any further comment? Anybody on the line?
Lisa, do we have any callers on the line?
There's no callers on the line.
Thank you.
Okay. Knowing that, we have a first and a second. All those in favor, say aye.
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 Opposed? Motion carries. Okay. C3. First quarter budget to actuals. Do we have anybody on the line to comment?
I have no written requests. Lisa, do we have any callers on the line?
There's no callers on the line.
Okay, so I look for Jennifer or
Me. I'm
Are
going to
you?
pass it over to Marcia. She's our budget analyst, and
What's
she'll
her
do the
name?
presentation.
Marcia.
Marcia.
Marcia. I apologize, Marcia.
Good evening, committee members. I'll be presenting the first quarter budget to actuals for the current fiscal year 25-26.
Okay,
We'll be reviewing the general fund revenues, the general fund expenditures by department and by category, the wastewater fund revenue and expenses, and the transit fund revenue and expenses.
C3. Oh, I see. Okay. I didn't get high enough. Thank you. Please go ahead.
In the graphs that will be presented, the bar represents the budget amount and the line represents the first quarter actuals. As of September 30th, 5% of the budgeted revenues have been collected. Most of the general fund revenue budget is from taxes. Property tax is usually recorded in December and May, and sales tax is received in monthly advance estimated payments and then a quarterly actual cleanup payment. Other taxes include motor vehicle in lieu, which is received in February and June. I lost my spot. As well as utility user tax, which is received monthly and accounts for the majority of the revenue received to date. Miscellaneous revenue will decrease as first quarter investment earnings are reallocated to other funds for their respective shares. Overall, we are taking a conservative approach and expecting revenues to come in at budget. During the first quarter of this year, we are still collecting revenues from the previous fiscal year. Therefore, the estimated figures remain preliminary. Do you have any questions?
I don't. Marcia, what is your last name for the?
Mason, Marcia Mason, Mason, M-A-S-O-N.
Yeah. I'll remember that. The goodbye girl.
Yes, spelled different.
Oh, yeah. Took me a while.
You got it.
Oh, okay. Okay, we'll go on to general fund expenditures by department. If you refer to page 3 in the staff report, it gives you the breakdown of the general fund expenditures by department, which reflects spending at about 19% of the budget. The departments that are either 10% higher or lower than the 25% threshold, higher than 35% or lower than the 15%, are highlighted in the report, which include non-departmental, economic development, risk and HR, animal control, community enhancement, fire, public works, and facility maintenance, which is a new department. So they're still staffing that department. Is there any questions so far?
I do have a question. So on risk and HR, could you give a little breakdown as to why that one's so high at the moment?
Yes, there's insurance that hits in the first quarter, so it takes up the majority of the budget.
And then that, with it being risk and HR, that is not payroll, correct?
Correct.
Okay.
And then fire That usually takes,
Yeah.
you
I
know, a
remember-
while to get the
I would
invoice.
often ask, and each time, fire sends their bill when they send their bill.
All the questions? No more? Okay,
I'm okay.
okay.
I'm good.
We'll move on to the expenditures by category. This chart represents expenditures by type for the first quarter. Personnel is currently at 21% of budget. Operating is at 18%. Capital is at 6%. And contingency is at 22%. Is there any questions on this? If there's none, I'll move on. Okay. Next, we'll go over wastewater revenue. Wastewater revenues are collected in arrears, and the July billing is accrued back to prior fiscal year, and the first billing for this fiscal year was collected in September. Billing is completed on a bi-monthly basis. As of September 30th, the wastewater fund has collected 17% of its budgeted revenues, which makes up the preparatory revenues related to billing. If there's no questions, I'll proceed. Wastewater expenses have a personnel of 22%, operating of 10%, and contingency is 9% of budget. If there's no questions, I'll continue. Moving on to transit revenue. As of September 30th, total transit revenue is currently at 21% of budget. Taxes are collected through Measure A. Intergovernmental revenue is RCTC funding, and it's at 22%. Miscellaneous revenue is interest, lease revenue, and EV charging, and that's at 17%. And proprietary revenue is the collection of fares and is coming in at 25% of budget. And that takes us to transit expenses, and overall transit expenses are currently at 21% of total budget, with personnel at 22%, operating at 19%, and capital at 14%. Is there any questions? Okay.
I'm good, Ms. Mason.
Okay. And then we have recommended budget adjustments. The increase administration for the HCL software, to increase community enhancement for weed abatement contract, decrease the OTS grant to match the amount awarded, and then transfers in for the amount awarded. Any questions?
That CDBG, that's transportation related, correct?
Is that under
Yeah, so page 54, the agenda,
the grant?
for the budget adjustments, it just says fund CDBG, the amount 46,500.
That is actually, it is a grant, and it was a PD grant. So the fund that it went into is collectively called CDBG, but it's our grants fund.
Okay.
But the grant was actually for OTS, which is, they do for I'm sorry. but
DUI
the-
stops and
Yes,
so
thank
forth.
you.
Okay.
DUI.
And so that grant agreement was originally budgeted for more than what was received. So when the grant agreement was approved, we had put in the staff report that we would be coming it back for a budget adjustment to reduce what was originally placed in the budget.
Gotcha, okay.
So the CDBG is an acronym for, is this just a grant?
That's a type of funding, but the actual grant, the fund itself is a grant fund.
Okay, thank you.
That concludes my presentation. If you don't have any other questions.
Any questions?
I just want to mention, usually I ask about if there's anything out of the ordinary, but the report clearly shows that you don't, it's stable and on track, and it's early in the fiscal year, so it's kind of early for that. But do you have any other comments that you see coming down the pipeline that we should kind of keep an eye out? Budget versus actual?
We're not seeing anything out of the ordinary. So the first quarter, a lot of times on the revenue piece, it's always lower than what you would normally see. And that's because at first, in July and August, we're still collecting revenues from the prior fiscal year and accruing them back. So as we start to go farther on in the year, we'll have a better idea of estimates and where we're going to land. So forecasting's a little difficult in your first quarter because the actuals just aren't there yet. But by the time we do second quarter, we have a better idea because we'll be halfway through the year.
Have you heard of any certain departments expressing concern that you want to keep an eye on as we get closer to actuals coming in?
Not currently. So anything we did have concern on, we have the recommended budget adjustments in
Okay.
here.
All right.
Very good. Any other questions or comments?
I do have one. In terms of taxes, especially on the real estate side, forecasts on that, we don't expect any major bumps or anything.
Not currently. So I was just reading a report by Beacon Economics, trying to see what they were saying, and they do see a cooling in the economy, but they're not forecasting any type of recession currently.
Okay.
So that's where we're at right now.
Because the more I read, the more it gets fed at you, So
Yeah.
I just figured I'd see what the city's perspective on it,
Right.
was.
And that's California based. So at local based, we'll start to see it. But if there were any, downturns, you would kind of see it on the property transfer tax and then maybe on sales tax. But currently, right now, we're not seeing that.
Okay, very good. And I know it tends to hit big cities first, and so we kind of watch what the bigger counties are doing, and then we kind of see it coming our way.
Right.
Okay, thank you.
So do I ask if there's anyone for public comment?
I have no written requests. Lisa, do we have any callers on the line?
There's no callers on the line.
Having heard that, I'll be asking for a motion to receive and file C3, first quarter budget, to actuals.
So moved?
Can I have a second?
I'll second.
All those in favor?
Aye.
Aye.
Aye. Opposed? The ayes have it. So moved. Let's go to C4. Pension and funding updates. Is that you, Jennifer?
Yes, that's me. So what we have for you this evening is a pension funding update. So our unfunded liability for our pension is a very large liability for the city. So annually, we do an update to provide you with where we are as far as standing goes with our pension. So I do have Dan with GovInvest. They are our consultant for pension, and they monitor that for us, and he has a presentation for you this evening. So I'll turn it over to Dan.
I'm here. Give me 1 second. There we go. Appreciate that. Okay. Some of you may have heard a presentation similar to this. I understand
Nicole.
there may be some new committee members as well. So I will cover a few things that are important to understand about CalPERS. Given that this is a defined benefit program, it works differently than a 401k or a 457 plan. The city guarantees the benefit and not just the contribution. And therefore, it really acts as a backstop for investment income. We'll talk about that a little bit more. Actuaries famously include a lot of assumptions in their projection of what the city's liability is. It is kind of it's an operating liability that kind of morphs over time. While there are things in their economic and demographic assumptions that if there is statewide movement or drastic changes in mortality, it might make some change, but it really takes a lot to move the needle in terms of these kinds of changes to impact the costs and affordability to the city. What does move the needle is the investment income. And, so there are three components that fund that defined benefit, and that includes employer contributions, employee contributions, and investment income. And in this slide, we can see that what the employee and the employer contribute, and it's really called the normal cost. That they call it the normal cost if all actuarial assumptions are met. Then really all that is the entire cost for the city. And you can see that the planned employee and employer contributions over time only represent 40 to 50% of the entire cost of the promised benefit. And therefore, when first of all, investment earnings are baked in to your normal costs. In other words, your normal cost contributions are net of assumed investment earnings. Therefore, if CalPERS at any time falls short of their expected return, they come back to the city and say, essentially you've undercontributed for that year. And sometimes those investment variations can be very significant. As Jennifer indicated, it's a large liability. Therefore, there are a lot of assets that are at play in the market. And so any variation in the investment earnings, because of this dynamic of it representing 50 to 60% of the offsetting the costs of the program, can cause some budget distress, and it can also change the city's funded status dramatically from one year to the next. So let's take a look on the investment related results, especially when you're going to see that they don't earn their return through on an even basis. It's through a series of ups and downs, and they'll point to their long-term returns, and we're seeing some improvement where all of the categories 1, 5, 10, and 30, except for the 20-year, meet or exceed their expected long-term rate of return of 6.8%. So there has been some recent improvement. You could see in the prior summation, you could see that even their 10-year return was on the worrisome side. And there are a lot of reasons for that, but we are seeing some improvement. And because of that assumed rate of return, a 6.8, really the measurement of whether they had a successful year or not is not whether it was positive or negative, but whether they reached that assumed long-term rate of return. So even in the instance where they came very close to that, the earnings, but fell short, there is an unfunded liability that is created for that shortfall, and that is sent as a bill to the city over a 20-year period. And that's really that self-correcting mechanism in which CalPERS makes sure that the amounts set aside in the pension trust, in their pension trusts, are sufficient to meet those future obligations. So just really quickly, the valuation that you just received, there is a lag between when the CalPERS prepares their valuation. It's the 24 valuation that sets your contribution rates for fiscal year 26, 27. And you just received the 24 val in August of 25. What's not reflected is the positive results of their June 30th 25 return, 11.6%. So it was another year that had a positive experience, and that's really your budget to actual. They had a favorable experience the last 2 years. The 4.8% is not reflected in your valuation, but that is where we assist the city and model the impact of that favorable variance. So how has your agency been impacted? You notice on the bottom I show the assumed return and the actual. And if you follow your funded status from year to year, you can see that it really follows how well they did with the investment results. So in the year that they earned a 22% return, that they beat their assumed rate of return of 15%, your funded status surged. And when they had unfavorable results, your funded status took a dramatic hit. And you can see that in the last couple years, so 23 was virtually flat from 22, but 24 and 25, you see your funded status improving to 81%, which is a pretty good funded status. As it compares to the CalPERS fund in total, CalPERS is about 79% funded, and your agency is at 81% funded. So 1.2 percentage points above the average, and that even includes agencies that have issued pension obligation bonds to bolster their funded status. So you're doing well. As it relates to other cities in your county, you're ranked roughly in the number 2 spot. And the reason I say that is Paris, the city of Paris issued pension obligation bonds. So while the proceeds of those bonds are included in your assets, the pension bonds that they need to repay are not included in the liability. So I would say on an apples to apples comparison, you're doing very well. You may be confused by this funded status. Note that this data set, which is the latest I have from CalPERS, is as of 6/30/23, and that your funded status has improved since to 81%, as we saw on that previous slide.
Dan, if I could go back to page 5, I see our actual return is 11.06. Is that correct?
11.6 for the year ended 6/30/25.
Yes, but I also saw that 2021 it was 21.3, and it's been lower since. Is that because of COVID and catching up from COVID? Is that why in 21 it was 21.3 return and now it's 11.6? In there it was a negative 6.1 and a positive 5.8, 9.3, and then up to 11.6. So is that why we're rebuilding from 21, the actual investments?
Correct. So this I should have marked that as a COVID-related event. I think what you see when you look at CalPERS's returns over time, they don't knock it out of the park as much, but they typically protect you from the downside losses, except for these more extraordinary events like the dot-com crash in the late 90s, the Great Recession, and we would also consider COVID as probably another black swan event. So yeah, it's indeed, we're recovering off of the COVID lows, and COVID came with, a fair amount of baggage that stayed with cities. That's a lot of inflation. Sorry, a lot of stimulus was pumped in the economy, and that drove some inflationary figures. Cities kind of paused for a moment and halted on some of their pay raises. So we're getting caught up, but we're coming out of. You're precisely right. Coming out of a time where there was a lot of uncertainty. The first kind of global pandemic in some time.
Yes, it looks like, though, most importantly, that it's trending upward. We've gone from 5.8 to 9.3 to 11.6, and hopefully that's going to be trending upward even more than 11.6. Do you see that occurring, Dan?
Yes, I do. And one of the reasons I wish I could overlay this, or at least more stability in the rates than we saw. So if you were to think about what the 10-year Treasury was earning in the 80s and the 90s, you see very little losses during this time frame because the 10-year Treasury was in the double digits, and we saw a 40-year slide that bottomed out in August of 22, where, if you remember, not too long ago, that the 10-year Treasury was less than 1%. And so it was very difficult for CalPERS. If 30% of their portfolio was earning less than 1%, how do you get back up to 7, 8%? So there was a lot of concern about the long-term rate of return. Well, as I mentioned, a lot of stimulus was pumped into the economy. Well, and pent-up demand. Those two things drove up inflation, which caused the Fed to drastically increase the Fed funds rate and ultimately the yield on the 10-year Treasury. So if 30% of your portfolio is now earning 4%, we've got certainly AI tailwinds in the market that are mainly probably the fixed income and a little bit of market tailwinds being propped up by AI. I would expect, at least in the near term, that returns will improve. Not to say that there may be one-off events where market participants are spooked by one item or another, and can cause a disruption like we see here. But in general, I generally believe that fixed income opportunity is going to stabilize some of the returns. But we'll look at some of the risks at the very end that should be on your radar as well.
Well, I thank you for that. It looks like it's trending upward, which is a positive way to go for our community and our employees. So thank you for that, and please continue.
All right, very good. So we've looked at the funded status, and we've compared to both CalPERS funded status in total in aggregate at 79%, and compared to some of your neighbors, albeit as of the 6/30/23 valuation. Let's take a look at how that has impacted your repayment, your unfunded liability payment. The blue represents where we were as of our 23 val. I mentioned that the latest val that you have today is your 24, and that you could see even that 9.5% return has lowered the trajectory of your payments. And when we bake in the impact of the 11.6% return, not only has your rate come down substantially, it's also brought your peak forward. So previously, most agencies, their peak payments were expected to be in 31, 32, and you can see that that has come forward to 28, 29. Now, I also want to point out this is very illustrative in that when markets, as markets are cyclical, and there will be negative returns in the future, that you can see that there is a drastic run up in cost, followed by a return of better returns. The challenge for Jennifer and the finance team is when those negative returns hit, there's a period of pain and distress on the budget to ride that cost upward before relief comes from those future returns. So with the city's staff leadership and council, last year's implementation of a volatility reserve will help ease the pain during that period of increase. You could see, while it's only a 15% increase from 25, 26, if we went, you could see even with the relief, there was a significant increase that the city had to endure while market returns became favorable again. So that is an area that all cities are exposed. Part of that has to do with CalPERS compressing the time in which you have to repay those from a 30-year amortization to a 20-year. And well, I guess that's mainly it. But I'll show on some future slides. There is risk in any one year to have those significant increases. When we look at the total employer contributions, so the normal, what we call the normal cost, if all actuarial assumptions are met, you're just paying for each year's service accrual, or that's the cost of providing this benefit on an annual basis if all things go right. What's represented in purple is the unfunded liability payment. Now on to the to the more pessimistic news. Finance directors also, while we hope for the best, we have to plan for the worst. And let's take a look at how how large some of these losses can be and why a reserve outside of CalPERS is necessary. So remember that leverage where 50 to 60% of those pension costs are presumed to be paid from investment earnings or offset by investment earnings. And underperformance in any one year can have a significant increase to your employer contributions. And then, most concerningly, is that can ultimately those UAL contribution spikes can threaten service delivery. So I commend the city for establishing a pension volatility reserve. To me, it's really the only way to combat investment or market volatility that the city ultimately can't control. Markets will do what they will, and the city has to be along for the ride. And it's finance and the city's job to how to insulate against that market volatility. And just to illustrate this, so your accrued liability is about 130 million. The market value of assets are about $100 million. And when we look at the frequency of future expected losses, you can see those experienced losses, even for a market return of only minus 5%, can cause an experienced loss of nearly $12 million. If you kind of widen the amount of negative results that could happen to say anything from a 40-year event to a more normal downturn, you could see that those losses can range from anything from $12 million to $24 million. And unlike your 401k plan where you can, you have to just, well, suffer through the paper loss, and just hope that markets will return. Unfortunately, during this period of time, CalPERS will send you a bill for this under contribution, the way they view it, and start collecting on that, on those particular losses. So it's very important steps that the city has done to kind of insulate the city from those losses. And while we're looking at the gross loss on this slide, the next slide represents where your UAL payment is today and where it could be if there were a hypothetical market loss. We're not predicting this. We're really just saying that this is the range of outcomes that the city needs to prepare for, where it's mostly, most of the time it would be less than this red line, and then those black swan events may, this would be more of a 40-year event. This is a 1 in a 6-year event that could cause some budget distress, and a rapid increase in your unfunded liability. And so, again, kudos to the city for taking that on last year, and having a pension policy in place and a reserve policy that will help smooth out those times of potential budget distress. Some other things to watch for in 2021, CalPERS once every 4 years kicks the tires and compares their assumptions against reality. And last time they did this in 2021, it was really in the middle of COVID, and the outlook was a little gloomier. They lowered their assumed discount rate, or their long-term assumed rate of return, from 7 to 6.8%. They lowered the inflation rate, which was, I thought, very controversial at the time, but they were looking, following the Fed's lead, that inflation was supposed to be transitional. As we know, it's been quite stubborn, and knew that would factor into their considerations in 2025. And during that time, they increased the wage growth assumption slightly to 2.8%. So where we are today is in September, staff recommended no change to the discount rate. So this is the most significant thing that's come out of this experience study, is that there's no change. The discount rate has the most dramatic impact on potential costs of the city. They did, not surprisingly, reverse course on the inflation rate and bumped up wage growth slightly, nudged it up from 2.8 to 3%, and some minor improvements to mortality. Ultimately, all told, given that they did not change the discount rate, that these are fairly benign impacts to the city's cost. So I think all in all, it's good news. This is only the staff recommendations, with the final board approval when the board convenes in November. Some of the economic considerations. Okay, there are a lot of headwinds out there. Really tariff uncertainty, whether tariffs are around or not. Just that uncertainty gives CFOs some pause for thought on whether they're going to expand on a, in any of their ventures. And if farmers aren't buying equipment from John Deere may not be buying If they're uncertain, they may not be buying the materials. So if when you have folks all sort of in that wait and see, that the economy tends to slow down if people aren't trading with each other. The offsetting that is AI is just is it is there's a lot of capital is flowing to rushing to AI. And so you almost have two economies really going on. You have AI that's growing like crazy, and everything else is slowing. So that is something to be concerned about. And that represents a downside risk. Now, while the market absorbs those ideas, and therefore you even see some of these odd things like poor labor numbers coming out. Well, then the market is looks ahead and says, well, then the Feds are going to lower interest rates and the market rallies. But if there are unexpected shocks, or the Fed acts in a way that surprises market participants, you could see that volatility. So given that there are a number of different things that potentially could affect the real economy or the markets, which is the perceived revenue from the economy, that collectively any one headwind or collection of headwinds could trigger both market volatility, and it could also impact your forecast. The net takeaway, as a former finance director myself, building in some budget flexibility, given that there is I think I'm generally still bullish on the market, but there's a lot of enough uncertainty out there. I would at least be have some professional skepticism to say things may not continue on a glide path, and that we might want to build in some flexibility when you build your budget for next year in case things don't continue on that same path. I know that may not be reassuring, but that's the best I have with the number of potential downside risks that are out there. And every bit of confidence that Jennifer is looking at all these events collectively, when in both budgeting, trying to insulate the city against pension spikes, as well as the impact on revenues. So I think that the city should feel secure with your staff at the helm. That'll answer any questions that you might have.
Are there any questions for Dan?
I guess I'll go first then. All right. Thank you, Dan. I appreciate that. I'm not sure if you can answer this or if this would go to staff. Maybe the first one would be you. So it looks like, when you look on the one page, that you have the funded status trend without the trust. And we're always under, and so there's, at some point, what do you think the investment return on the account on PERS would need to be, so, to a point where we wouldn't have to get a bill from PERS to catch up? Do you understand my question?
I do.
I mean, is it kind of unattainable, or?
Sorry?
Is it, in a way, unattainable?
Well, I wouldn't have an expectation that your unfunded liability will go away. I think it's something that needs to be managed. It's an operating liability, much just like your general liability or workers' comp. Every year, you're going to have some unexpected events. So the best I think the city can do is try to mitigate that risk. Certainly, while you can maybe manage trip and falls the best you can, and both, workers' comp training. You can't really control the market. And but to answer your question more directly, so they would have to beat the expected expected rate of return by about 20% to get to 100% funded status. So you're almost 20 percentage points.
Okay, no, Dan, that's very helpful, gives me kind of a perspective. So then,
Okay.
the next question then is probably going to staff, is how much are we putting into that volatility and reserve fund? What has been our general rate of return on that? And then would it make sense that if we have good years on the rate of return, almost like a dollar cost averaging in reverse in a sense, where I'm heading towards is, if we've got a good year in terms of the PERS investment, our bill's smaller. But if we've got, let's say, perhaps a set dollar amount that we've calculated that we should put in there, expecting some ups and downs, that maybe we budget that dollar amount, and that'll, in the good years, it'll help, and then the bad years, it's still the same dollar amount, but with the same result at the end.
Right, so the pension funding policy that was adopted by council has in there what will be put into the pension 115 based on where your funded status is.
Okay.
So every year at budget, we look at what is the funded status for the audit report that came out previously, and then we will budget for how much we're going to put in the 115 based on that funded status. So we do have our PARS, Pension 115 Trust, and as of 6/30 of '25, that 3-year return was 9.78%. So that is basically what you would made on average over 3 years on the portfolio that we have invested with PARS. So there's different levels of investments, and when we decided to get into PARS, we did it's not the most conservative level, but it's considered moderate, so it's kind of the next level from conservative, so that way you're not taking too much risk in your 115.
Okay, and then how much have we been putting into that? Do we have a general dollar amount?
It varies
And again,
year by
is it-
year, but so I would say when we first did this pension, the 115 trust, we did 2.5 million. Currently, we're at 4.3. So that's been over, I think, 3-year period.
Okay.
And that's also with the returns. So that kind of gives you an idea of what we have been contributing to it.
So is it still a little bit of looking in the rears aspect of how much to put in?
It is, because that's the information we have
Okay.
to go off on what we're going to put in.
Is it possible to project out and say, hey, if we think we do this, it'll help us, or is it just too much of a moving target?
Well, you could council could make a decision, so at budget time, say we're looking at the numbers, you could say, well, we're doing this much into the pension 115 trust. If council at that time wanted to put more into the 115, we could, but we try to follow the pension funding policy.
All right, and then there's other budget decisions to make at the same time.
Right,
Okay.
right.
All right, thank you, appreciate it.
I'd like to recognize Councilmember Martinez for questions.
Thank you, Chair. So my first question was kind of along the lines of the 115 is how often we evaluate it. So it's an automatic kind of how we adjust, and then yearly we take a look at it to see if we want to go higher or lower, or do we just keep it like that for a certain amount of time?
Right, it's different levels based on the funded status, is
Oh.
the way the pension policy is written.
Okay, thank you for that.
So if you're less funded, you're gonna contribute more.
Of course, okay. And then how often does the discount rate evaluated for CalPERS?
Dan, how often are they doing that? Is it every 3 years?
Once every 4 years.
4 years?
Okay, and I figured that from the 21 to the 24, so. Did CalPERS, remind me, did they ever go into that restricted investment policy that we had talked about at one time, where they were gonna have that list that they weren't going to include in their investments? Did they
Okay.
follow through with that?
Did you want to update them on that, Dan?
So, are we talking about?
There was a discussion, Dan, a while back where CalPERS was looking at, restricting who they invest with. It was more of the political type thing where they wouldn't do,
Sure.
tobacco or whatever. did they ever go to that extreme, or did they compromise, or I don't remember whatever happened. with it.
It's an ongoing program. They do feel that it has some impact, and as I understand, their logic is they they can control outcomes more so if they have a seat at the table. It's it's very controversial, and it's hard to quantify whether it helps or hurts the return. But it is something that CalPERS, it's an active program that CalPERS is continuing to pursue.
And then my follow-up question was going to be exactly that, is that can they quantify whether that was helping or hurting or so forth? So difficult
With fuzzy
questions,
math,
I know.
I think so, but
Yeah,
I think
okay.
it's pretty fuzzy.
I was just curious because I can't remember if we came to a conclusion, or I know they were in the beginning of that discussion and I don't know what happened. I figured I knew what was going to happen, but I thought I'd ask the expert.
Yeah.
Okay, that's all, Chair. Thank you.
Thank you, sir. Any other questions?
I do have one more, if I could.
Please, Councilman.
Thank you. Dan, so question for you. So when a city is unfunded in a sense and the bill comes, what happens if there's a good number of cities that are broke at the time and they do not send that in? Does that hurt the whole program as a whole, and do other cities and everybody as a collective whole get penalized even more if those funds don't come in as expected?
No, your assets, even so, there are two types of plans. There are risk sharing plans that participate in a pool, and there are agent plans. In both cases, your assets are your assets. Okay. So if you fall short and aren't able to contribute, that falls back on the agency. I don't know that there is an agency out there that has wiggled out from under CalPERS. It seems that when that eventually goes to court, CalPERS usually is able to extract their pound of flesh. But even if it didn't, it would go to reduce the benefits of that particular agency, and would not be necessarily spread across other agencies.
Okay, appreciate that, because I've heard in the past where a lot of cities were unfunded and so forth, and it just sounded scary, and that it sounded like the whole system was kind of teetering based on a city's ability to pay. And so I think that was just a false narrative that I heard. So
Yeah.
I appreciate the explanation.
I don't know that it was false. I think, especially after 2008, there was a lot of concern, that there was this pension tsunami, that it was, CalPERS had to do two things. They had to lower their investment offset, or their expected rate of return. And they also had to have a more aggressive collection policy, because way back when they had a 30-year policy of that was so it was a very generous policy that really assumed very little repayment by agencies. And it was really based on a premise that the markets would return to normal and cover those past deficits. And when the 10-year Treasury was falling as fast as it was, that liability was very scary. And but I think they're righting the ship. And you can see the fund in total is close to 80% funded. Which to me is in the safe zone.
All right,
If I could just
appreciate
add too, so the pension 115, if the city were ever to come into an issue where the budget couldn't absorb an additional cost,
Make
you
that
can use
withdrawal.
the pension 115 to make the contributions to PERS. So that's what it's there for too.
So as long as our budget's been holding well and that bill comes, we write the check, send it over, but if we're not having to touch that reserve fund, that can continue to grow for potentially a really bad rainy day, in a sense, right?
Right,
Okay.
correct.
Thank you.
Thank you. Is there any other questions? No other questions. I am looking for a motion to receive and file the pension funding update.
I'll move.
I'll second.
And before we do a motion, I'm just going to check to make sure we don't have any
Okay,
callers on the line.
I'm sorry, I got that written down, I didn't read it. Are there anyone for public comment, Nicole?
No written requests. Lisa, do we have any callers on the line?
There's no callers on the line.
Having said that, we have a motion and a second in front of us to receive and file this pension funding update. I guess in roll call. All in favor, say aye, please.
Aye.
Aye.
Opposed? Motion carries. So now it looks like we have a report about internal control committees. Vanderpool, he's not here, so apparently there's none. Consultant Review Committee, I don't have anything on that, so none there.
And if I can add, we will be doing a RFP for our investment advisors coming up. And so we will be asking for 2 members from that committee to review.
Very good. RFP for what purpose again?
Investment advisors.
Okay. So Nicole, that would be brought before us at the next meeting, as far as setting the members of that? The members of that now are me, and it was me, and council member, pro tem, but now she's not here, so do we have to appoint someone else to be with me on that committee?
Will you be bringing that before the,
No, we'll be releasing it in November. So we'll need someone we'll need the review before the next meeting.
okay, so we'll need someone appointed this evening then? We can do that under this item.
So we'll add another person to that ad hoc or subcommittee by what time? The next meeting?
We would do it this meeting.
Okay, so would that person be myself, because I know I was on that committee before. So be one of these 2 gentlemen, or somebody's filling in for somebody?
Unless you assign
filling
someone
in
that's not
for-
here.
Yeah, I always feel it should be community member and not a council member myself.
So that would be Christian, is that correct? Okay. so
Or
can
Mr.
you get ahold
Vanderpool.
of him and-
So let's
Vanderpool.
do an alternate
I
then.
apologize.
We'll,
Yeah, and
so we'll say the first.
could we go Christian first,
Yeah,
since he's
first
our
we'll
newer guy, give him the opportunity, and then if he's not available, then we'll ask David.
So would they contact him by mail or phone to see if he'd be available for that, to be on that committee?
Yes, I can send him an email right after
And
this.
you would get back to, I guess, me, because I chair that committee, is that correct?
Yes. I'll
And
send
then
an
in
email out.
the unforeseen event of neither one being available at the time frame that it needs to be reviewed, then it can come back to Julio or I, right?
Yeah, so it'll be,
So it can be the one of you 2. The third option would be, after Christian, would be yourselves. Okay. Just, yeah. If you
So
would,
to make a motion out of it, I move that we ask Christian to serve on this subcommittee with David Vanderpool as the alternate.
Mr. Vanderpool is the alternate.
Yeah.
Okay, and then me as the chair. I've got a motion, do I have a second?
And Christian's last name is,
Fernandez.
so Christian Fernandez as the
first.
as the member,
Yeah,
and
David as the
David Vanderpool as the alternate.
Christian Fernandez, just a second. And David is the second. Okay. We have a first, we have a motion, we have a second. Did I ask that? If I did, I apologize.
I don't have a second yet.
Oh, second.
I was going to second something if I had to. We have a first and a second. Could I have a, not a roll call? Anyway, everyone in favor, please say aye.
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 Aye. Opposed? Motion carries. So Nicole, you'll let us know? Let me or David let me know. Okay. So the next thing on the agenda, committee member comments. So we've got three of us.
I'm good.
Yeah.
I just want to give a quick thank you. I appreciate Dan being here tonight and explaining things. Each time we hear it, the picture gets a little more clear, a little more clear, a little more clear. By the time I retire, I'll know what I'm doing.
You glean a little more. That's the way I approach it.
So I appreciate the
I
effort
thank-
that went into
And I
it,
want
so
to
thank
thank
you.
Marcia Mason. Thank you. Pleasure meeting you, and welcome. And thank you for your comments. Treasurer, review and comments. Who's the treasurer? Do we have a
Not
treasurer?
present today.
No, I don't see it. Oh, that would be, yeah, I know who that is. I haven't seen him for a long while. Anyway, finance director comments.
Yes, the only comment I have this evening is we are starting to wrap up our audit for fiscal year '25, and we will need to have a special meeting to review that draft audit report. And we are looking at Monday, November 17th.
And that would be this group here, is that correct?
Correct.
And that'd be at 6 PM?
Yes.
Just a comment or a question. So, as far as you know, that the audit who we kept on, a different group of people, are they doing it looks like they're doing a very professional job and things look pretty well?
Yeah, no,
I
they've
mean,
done a
it's
great job.
continue to do the great work they were doing before.
Absolutely, yeah.
Okay.
And it's been running pretty smoothly.
Good to know. Thank you.
So I might have a conflict. I do have something scheduled from 6 to 7 on that day, so I'll see how I can do it.
Okay.
Just
Okay.
forewarn everybody offhand.
I have a jury duty notice that starts that week, but if I do get called in during the day, I should be out by then, so I would expect to be here.
Okay. Well, we will make adjustments if we have to. Okay. We're by the last page. Looks like adjournment. So any other comments or questions? If not, at 7:08, we will be adjourned.
There you go.